Welcome to this explainer, where we are going to definitively crack the code on maximizing your retirement accounts for early financial independence. Look, if you're aiming to leave the workforce decades before the standard retirement age, the standard financial advice you hear every single day, it might actually be costing you an absolute fortune. So let's dive right in and completely flip how you view your retirement savings. It's the question that basically plagues every single investor out there, right? Traditional or Roth? To really unpack this, let's frame this as a debate between two highly prepared investors. On one side, we have a man who is incredibly confident, arguing that the Roth IRA is the ultimate wealth-building tool, period. Facing him is a woman who tells him, politely but firmly, that he's completely wrong when it comes to early retirement. Today, we're going to look strictly at the definitive math she brings to the table to find out which account type truly comes out on top. Here is how we're going to settle this today. First up, the Great IRA Debate. Second, decoding the account types. Third, the Roth conversion ladder. Fourth, the six-figure difference. And finally, we'll wrap up with the rules and income limits.
All right, Section 1, the Great IRA Debate. Finding the definitive answer.
So the man in our debate starts off strong. He argues that the tax-free growth in a Roth is just unbeatable. And, for a standard retirement timeline, he might actually have a pretty good point. But the woman across the table, she points out a massive flaw in his logic. The unique timeline of an early retiree flips the script entirely. When you plan to retire at 40 instead of, say, 65, you unlock these incredible tax planning windows that most people never get to experience. And mathematically speaking, there is a definitive winner.
Moving to Section 2, decoding the account types. When do you pay the tax man? The fundamental choice here is simply deciding when exactly you want to pay the IRS. I like to think of it like a farmer. Do you want to pay taxes right now on the seed before you plant it? Well, that's your Roth IRA. You fund it with after-tax dollars, it grows tax-free, and you harvest the whole shebang completely tax-free. Or do you want to take a tax deduction today, pay absolutely no taxes on the seed, let it grow tax-free, but then pay taxes later on the harvest? That's your traditional IRA. Now here's a curveball, and it's this third option, the standard taxable account. While both of those IRAs we just talked about offer wonderful tax shelters, this account offers absolutely no shelter. Zero. The money is taxed before it goes in, and the growth, like your capital gains and dividends, is taxed along the way. But it provides ultimate flexibility. You can grab this money at any time, no age restrictions, no early withdrawal penalties. Keep this in the back of your mind, because this flexibility becomes a vital piece of the puzzle in just a minute. Section 3, the Roth conversion ladder. The three-step strategy. What if you could literally outsmart the system to get the best of both worlds? Tax-free contributions, tax-free growth, and tax-free withdrawals. This is the exact moment the woman in our debate introduces her secret weapon, the Roth conversion ladder. This hidden wealth-building hack lets you strategically slide money across accounts when your tax burden is at its absolute lowest. Step 1, shield your money from high taxes while you're working by using a traditional IRA. Step 2 happens the day you quit your job to retire early. You start slowly converting that money into a Roth IRA. And step 3, you wait 5 years and bam, you can withdraw those converted funds entirely tax-free. So the real magic trick is how you actually make that conversion in step 2 tax-free. See, when you convert from a traditional to a Roth, the IRS treats that amount as ordinary income for that specific year. But wait, if you're retired early, your earned income just dropped to zero, right? And everyone is entitled to standard deductions. By converting an exact amount equal to your standard deduction, your taxable income stays at essentially zero. Standard retirees never see the income drop necessary to pull this off cheaply while they're still working. But early retirees, they can use their low income years to perform this conversion completely tax-free. And this timeline perfectly illustrates the exact path you have to take. During your working years, you're shielding that high income. The literal moment you hit early retirement, you begin those gradual conversions. But, and this is a big but, you must wait 5 years after each conversion to access those specific funds if you want to avoid a strict 10% early withdrawal penalty. This is exactly why you need savings in that standard taxable account we mentioned earlier. You need something to live off of during that initial 5-year waiting period. All right, Section 4, the six-figure difference. Investor A versus Investor B. Let's put our two debaters head-to-head in a mathematical matchup. Let's say they're both 30 years old, they both earn $60,000 a year, and they both plan to retire in exactly 10 years at age 40. In retirement, they both plan to live happily on $18,000 a year. The man, investor A, decides to stubbornly max out his Roth IRA every single year. He takes whatever leftover cash he has after paying his high working year taxes and tosses it into a taxable account. The woman, investor B, maxes out her traditional IRA. Because she takes the tax deduction today, she actually pays less in taxes than the man, right now. So she takes those exact tax savings and adds them to her leftover money, investing all of it into her taxable account. Once they hit 40, they both stop contributing. The woman begins her zero-tax Roth conversions up to the standard deduction limit. By the time they both reach standard retirement age at 60, both end up with the exact same amount of money in their Roth IRAs. But here is the massive mic drop moment, where the woman definitively wins the debate. Investor B actually ends up with over $100,000 more in total net worth. Seriously, let that sink in for a second. Just by choosing the traditional IRA over the Roth IRA, she created a six-figure advantage for herself, starting with the exact same salary. So how did she mathematically crush him? It's pretty elegant, actually. Because Investor B didn't pay taxes on her IRA contributions during her working years, she literally had more upfront cash in her pocket every single month. And she didn't just spend it. She invested that extra cash into her taxable account. Over a decade of working, those tax savings compounded massively in the market. When early retirement hit, she just used that beefed-up taxable account to live on during her 5-year conversion waiting period. That initial tax shield snowballed to create a massive six-figure victory. Let's move to Section 5, Rules and Income Limits. Always mind the fine print. The upfront tax deduction is the absolute engine driving this entire strategy. If you currently have a very low income and you just don't pay much tax anyway, the deduction doesn't really help you. In that specific case, yeah, you actually should just use a Roth. On the flip side, if you're a high-income earner, you need to be really aware of your Modified Adjusted Gross Income, or MAGI. If you're single and covered by a workplace plan, traditional IRA deductions phase out completely at higher limits, like around $71,000 in certain tax years. If you earn too much to claim the deduction, this specific ladder strategy won't work for your IRA. At that point, you should pivot to a backdoor Roth, a mega backdoor Roth, or honestly, just rely on a standard taxable account. And please, never forget the golden rule. Withdrawing converted funds before that 5-year mark triggers a very painful 10% penalty. So what is the big takeaway from all this? The standard, run-of-the-mill advice to just blindly funnel money into a Roth IRA? It simply doesn't hold up to the math if you are aiming for early retirement. I want you to take a hard look at your current contribution strategy, your retirement timeline, and your tax brackets. Are you truly optimizing your seed and your harvest, or are you accidentally leaving a massive six-figure sum on the table? Because optimizing your accounts today could literally change your financial trajectory forever. Thank you so much for joining me for this explainer, and I challenge you to go run the numbers for yourself.